Hello, a very warm welcome to all. My name is Hassam Ali. Today in this presentation, we will discuss about the types of investors. What are the types of investors in the stock market, and we'll see who are these types of persons and their characteristics even as well. So without wasting any further moment of time, now let's start our video. So the first we have is the type of investors. While we often hear stories about intrepid individuals funding startup using the bootstrapping strategy and investing their own wealth and earnings, that strategy is sometimes unrealistic or downright impossible. More often, fielding startups must seek investors to help foot the bill for their projects. Five common investor types for startups include the banks, angel investors, peer-to-peer lenders, venture capitalists, and personal investors. So now we'll first start with the banks. Banks as investors. A small businesses seek bank loans to help with startup costs. Because 2007 mortgage crisis, as we all know, it is now more challenging to qualify for a bank loan. It helps to have a personal experience in the industry or a good mentor who is well versed in the industry. Companies may help to provide collateral such as home equity loan and much as startup cash as possible. The bank typically requires a comprehensive business plan that includes a complete detailed description of the business, a description of the business core products, financial projections, management projections, and plans for the goal implementation. So when bank act as the investors, they basically invest their money into the stock market, and they get a return from their particular investments. Okay, so that is the one category of the investors. Now we will move ahead with the other parts. Angel investors. An estimated 268 active angel investors in the United States and invest in estimated 20 billion to 60,000 companies a year. The average investment of the kinds total is $74,955. Angel investors are usually wealthy entrepreneurs who want to leverage their wealth by investing in projects they are passionate about, especially startups that may have difficulty accessing more traditional forms of financing. Many angel investors are successful entrepreneurs themselves as well as the corporate leaders and business professionals. This investment is typically in the form of either a loan or a stock purchase. Sometimes they also help mentor or advise the business in which they are advising. For example, some angel investors specialize in a specific type of company such as new technologies. So this was all about the angel investors. Now we'll move ahead with the peer-to-peer lending. With peer-to-peer lending, startups and entrepreneurs can create online profiles for their projects on websites like Proposer and Lending Club to be considered by investors. These services try to match small businesses owners with entrepreneurs while cutting out the middleman. So the small business associations recommends that startups interested in the peer-to-peer lending develop a business plan and company story that shares their progress and key achievements, as well as the results of the market research, industry analysis, and financial forecasting. You should also be prepared to share how much you have already invested yourself. The goal is to show potential leaders that your business has what it takes to earn money and be successful. So this was all about the peer-to-peer lending. At the fourth row we have is the venture capitalist. We see, as you all know, that is the venture capitalist invest millions in a company by securing a share in a company known as the equity capital, as we all know that. The investment is predicted on the idea that the equity capital will increase in value over time and they'll receive a return on their initial investment. So this is what the basic structure of the VCs is all about. This type of investors typically works with companies who have a solid business plan and have already displayed some measures of success. You need to show a solid business plan and high profit return. Venture capitalists rarely invest in startups perceived as risky. Business owners should know that when investing with a venture capitalist, they are giving up partial ownership in the company. Some venture capitalists will want a share in management decisions, and you'll also likely pay a higher ROI to these investors than the cost of interest on a traditional business loan. So this was all about the venture capitalist. And so at the last we have is the personal investors. So who is a personal investor, or we can say a retail investor? A retail investor is a non-professional investor, also known as individual investors. Retail investors have an increasing impact on the market. Anyone who doesn't do investing as a career is considered as a retail investor. So the retail investor is just like a normal simple person who in the market invest and who basically tries to expects a return on their investment, like every other investors we have seen as through the video. So these are the type of investors which are not so very much sophisticated as like VCs and other institutional investors, but they are more often of a high growth, and their objective is to do an investment which will gain into a highly prospective and there over a long period of time. That is what their objective is all about. So this was all about the types of investors we have gone through. Thank you all for listening. My name is Hassam Ali, signing off, yourselves.com. Thank you.